Looking at the payrolls report in its totality, the upward revision for me kind of offsets the downside surprise for the previous month. The same read for you?
Look, I say the same thing every time. Ultimately, to the extent that we're using these figures to read the tea leaves around rates and what's going to happen to them and what's going to happen to the rest of the market in the U.S. and globally, it was always, frankly, an irrelevant number because it's just one in a stream of really strong data points that will continue to drive rates higher. And frankly, for rates, it is all about supply demand. And the supply demand, the technicals are not supportive for continued Treasury rallying, and that is the real reason why we've seen the significant move recently. But absolutely, this is a number that will continue to guide Fed to a higher rate level.
Rick, just to pick up on Oksana's point over the data, we're averaging in and around 200,000 every month this year. It's pretty strong.
It's unbelievable. I mean, it's hard to say where is full employment. You know, what everybody was keyed on this morning is what is that average hourly earnings number? Because what is the rate of acceleration in a tight labor market, very, very tight labor market? How fast is inflation, is wage pressure building? And you saw it wasn't as high as many had thought. So it was, you know, it was a strong number. I would argue it's a solid number, and particularly of a messy hurricane dynamic. But that average hourly earnings keeps trending higher, but it's not moving out of control, which is big.
Yeah, Bob Dole, don't be distracted by the 134. There's a much better picture out there, right?
Yes, with the revisions, as you say, the number was very strong, and I agree with Rick. As an equity guy, I'm watching carefully the wage number. I don't want companies to start saying, I got margin problems because wage rates are moving up. Thankfully, they're moving up, but slowly.
It's happening slowly, Michael, but it's happening surely, isn't it?
Yeah, so the wage numbers are moving up just in line with inflation, right? So real wage growth is still really moderate. I mean, it's barely positive, if positive at all, right? And to Bob's point, the margin pressure, I think, is probably the next big story, right? We've canvassed a lot of the companies that issue debt that we follow, and very few of them really have the ability to pass through these higher wages and other input costs to their end customers, and that's going to be a big theme as it plays out.
Are you exploring the same dynamic, Rick, this idea that maybe the capacity to sort of pass on the higher costs to the consumer price tolerance just isn't there?
Yeah, I think it's a totally different world of commerce than it's been historically. Your ability to just, because wages are accelerating, in a normal manufacturing goods-oriented economy, you'd get significant inflation. You're going to get inflation, and inflation's ticking up, but not nearly as high as possible. By the way, not only is wages pressing on margins, but interest expense is a very big part of a company's income statement, cash flow dynamic, and that's also going to pressure margin a bit going forward.